So, you may be asking yourself, what are dividends, and why most of retail investors prefer to allocate 10 to 20% of their portfolio to dividend stocks? No worries, I've made this video specifically to answer your question. So, what are dividends? Dividends are simply how companies rewards its shareholders for holding the stock. The company can release the dividends in many forms, but the most common is the cash dividend, and each shareholder is free to choose what to do with the cash, either to reinvest the dividends in that company again or to spend it anywhere else. No legal obligations to that. And usually, dividends are released on a quarterly basis. And if you're wondering how long do you have to hold a stock to be qualified for dividends, you'll simply need to own it for an average of 15 to 20 days before the dividend release date, as the ex-dividends dates vary between one company to another. But, with all of that being said, ones may wonder, why does a company even pay any dividends in the first place? And the answer is simple. You see, dividends are actually a form of cash surplus, which means the company is making a profit and getting bigger, which translates in the stock market as a sign of power. Therefore, the company's stock will surely attract much more investors, which in return will increase the company's capital, leading the company to expand in a much faster scale. And by knowing that, we can say that dividends are an indirect way of the company investing in itself. And by the way, when it comes to taxes, dividends are taxable in some countries and identified as capital gains tax. So I highly advise to reconsidering checking up the dividends tax situation in your country. So, now, we've covered almost all of the basics about dividends, so why not see an example of how the concept of dividends investing may look like? Here we have a soup manufacturing company who has a current share price of $20 and an annual dividends of $4 per share. So, you went ahead and spent $200 on 10 shares of that company, and for the next 3 years, you've been collecting dividends on an annual basis. And by the end of the third year, you sold the 10 stocks at the same price you bought them with. Now, you want to break down that investment to see if it's really profitable or not. Here, we have the $200 initial investment. And here are the triple $4 you earned for holding the stock for 3 years, multiplied by 10, which is the number of stocks you bought. So, the end results you have will be $320. Now, looking to that example, we conclude that you actually made $120 as profit on your investment without doing anything except investing in a strong company, and forgot about it for 3 years. And that's, my friends, how Warren Buffett invests. I remember when I first started studying for my bachelor degree, I was very hyped over Buffett, and he had a saying that summed up my investing future since then. He said, imagine if you're allowed to invest in only 20 companies for the next 10 years. Only 20 companies. Would you still be holding the ones you have in your portfolio right now? And that's just insane, as from that moment I began to think twice before judging on an investment. Even if the numbers are doing good, yet there are other aspects to look for. And by the way, I've been preparing a long list of what to look for during the process of evaluating a stock, and they'll be released here on this channel, so make sure to stay tuned. Anyways, that was it for today. Hope this video helps in your next investment decision. And if you have any interest towards the stock market and how it works, and what are the best proven strategies that actually work, then I'll be honored to have you on my channel as a subscriber, as I'll be sharing most of what I've learned through the years here on the channel. And if you have any question related to finance or investing, please feel free to leave it in the comments section below and I'll make sure to answer it as soon as possible. And, till next time.